two very special guests. So you could call them the UBS think tank, and they come to us in the month of December to try and understand how is it that they have looked at 2025 and what could be in store for an equity investor per se in 2026. Sunil Tirumalai of UBS as well as Gautam Chhaochhariav join in. Gentlemen, both of you, thank you so much for taking the time. I really appreciate your time. And either of you can start. Maybe I'll go in an alphabetical order. And Gautam, I'll start off with you. How do you see the performance of equities and the risk to it from 2 or 3 factors? If geopolitics was the risk for all of 2025, suddenly the Japanese yields rising has become front and center of all conversation. Is that something that will eclipse most other risks to equities and risk assets for the near term?
It doesn't seem to be happening as we speak for the broader markets. For India specifically, I think I'll let Sunil answer that Japanese yield question from his EM lens. But from an India perspective, I think Indian markets this year have been boxed, so to say, in a triangle of strong retail flows, but also coinciding with huge capital raising and rich valuations. In the context of fundamentals, and that boxing has continued being in that, so it doesn't come down much, but it doesn't also go up in absolute terms. What it's also meant is that India has underperformed the rest of EM because we saw strong earnings momentum in the rest of the EM, specifically the tech-driven sectors. Now, whether this changes going ahead or not, look, the retail flows likely to continue strong. The capital raising pipeline remains huge. The question boils down to valuations and fundamentals. So valuations, even despite market stagnating, are not attractive in absolute terms. Yeah, I could say related to a year back, 2 years back, slightly better, or related to EM, less of a premium. But the key driver here on will be the local growth fundamentals. And that's where the debate around tariffs or geopolitics will come in as to how that weighs or does not weigh on the visibility of growth recovery in India. I'll hand over to Sunil in terms of the EM lens on the Japanese yields.
Sunil, so Gautam, thanks. But Sunil, no, I'll peg in one more thing there, right? One is the Japanese impact on emerging markets, and two, emerging markets, within the emerging markets basket, the fact that India has underperformed so much over the last 14 months, does that kind of give a bit of a floor to any large global event that may impact emerging markets?
Right. Thank you. Good morning to all your viewers. Let me answer the 2 parts to your questions, one after the other. I don't think I would make a big deal of the Japanese yields going up, or what people like to call as the carry trade and the unwind and so on. If you look at what's happened over the last 12 months, 18 months in terms of global portfolio flows, the world has bought record amounts of the US, in 2025. It defies all commentary and worries that people had about how the US is losing its exceptionalism and so on. But basically the US stock markets and the Mag 7 and the AI and tech names have been the favorites for global equities investors. Elsewhere, it's no longer the foreign portfolio flows that are actually determining outperformance or underperformance in a big way. And US did not outperform, even though global portfolio flows chased US in a big way. And that's because in most markets, it is the domestic money that's actually beginning to drive what leads to performance and underperformance. And and as we've seen in the case of India, it's not just domestic inflows, but also the outflows through capital raise activities that Gautam mentioned. And all of those things, do become important. I think the themes that you want to be, careful of or be watchful of into heading into next year, I don't think it's going to be tariffs and trade, as you pointed out. But whether the AI trade globally has more legs to go, will there be more investments? When will revenue start, coming up? When will productivity gains start coming up? And those are the questions that you need to kind of think of. Now, coming to the second part of the question on India in the emerging markets context, let me put a few numbers in perspective, right? We have a quantitative tool that we call as a perception score. It's just a sentiment score, which looks at a database of about 800, 900 stocks across emerging markets and basically tries to answer, if I take an average random emerging market stock and list it in various markets, what premium or discount are you getting, right? So I just keeping the growth same, the ROE same, the same sector, and all of those things. It's just a single, similar, same stock that moves around from one market to the other, and what kind of premium or discount. India historically, pre-COVID, used to get a 30% premium. Justifiable. That's the India growth premium. That's the India quality premium that you could argue. That has now steadily gone up to 90%. Right. I mean, I think it kind of peaked at 95% last year, but it's now down to about 90%. So that basically means that for a foreign investor, a bottom-up investor who's looking at investing into India, for the same growth, ROEs, and same sector, it's a similar stock, you need to pay 2x the valuation in India, right? So that's a good thing. I mean, in the sense, you can, Indians can feel proud that the companies here are being valued so much, but it also means that on an ongoing basis, it's so the returns expectations for a foreign investor is going to be that much more challenging when you're already having to pay 2x. So I think that's why you're also seeing that the foreign flows have not been super convincing in terms of coming back. I mean, there are months when it comes back, but generally it's been very weak.
So, Sunil, to add to that, good morning, Hiral on this side. Considering this past trend where domestic investments have driven the markets, how does the shifting dynamic of domestic versus foreign institutional investors actually impact your outlook as well, if you have to look at India then?
Well, okay. So, as I said, in most markets, you need to pay close attention to what's happening to domestic flows. And India has been very strong post-COVID. Other markets are kind of catching up. I mean, some of the enabling conditions that were ripe for flows in India are kind of becoming relevant in other markets too, including policy support and focus on corporate profitability and returns and shareholder returns and so on. So I think the reason why, from an emerging markets perspective, we still are kind of on a relative basis, we are still cautious on India, purely on a flows basis, is that the pickup in supply of equity capital or demand for equity capital from corporates is actually going up significantly as well. And it's I mean, I won't take names of companies, but there are companies who did a big IPO 2 years ago. All the money went into the selling shareholders, and now they're coming back apparently to raise money for their own operations, again a big amount, right? So there is a big rush to tap into this, flows that are coming in from households.
Okay.
If you look at some numbers, pre-COVID, the demand for capital, i.e., corporate capital raises, was about 10% of the retail flows that are coming into the market, right? Now, on a larger base of retail flows, that number is north of 25%. Right, so you have a lot more money being demanded, and of course, you have to also take into account foreigners selling.
Basically, the domestic flows is something which is something that everyone is tracking right now. Which becomes important. And to take that conversation forward, Gautam, I would want to come to you on valuations. We're talking about valuations which are still elevated. Now, how are you expecting the corporate earnings growth to perform to justify these valuations and drive that further market upside? What would you want corporate earnings to be like?
So look, the corporate earnings is in two parts. One is some recovery based on a low base, based on, say, GST, based on income tax cuts, etc. That's kind of what's baked into analyst estimates, and I think the street is already pricing that in. Will that be enough for markets to break out of the box which I described in the beginning? I think not really. You will need a stronger growth recovery than what is being baked out based on analyst estimates or from all the macro drivers. And what can drive that? Obviously, the tariffs, etc., can make a difference because that will create sentiment, exports pick up, etc. That will make a difference. Secondly, the local part, the one thing which can make a difference, which is difficult to model right now, is how the credit cycle pans out. And that's what we discussed with some investors, whether the recent bottoming out of the NPL cycle, the recent commentary about growth in credit, does this mean a stronger pickup in credit growth? That's not being baked in by investors or by analysts. And that could be an interesting one to watch out and look at closely. Because, look, frankly, we've seen rate cuts, we have seen liquidity easing. But one of the things which drives credit cycle is also easing of credit standards. So as banks become more comfortable about the credit standards in their lending, including the oversight from RBI, that could drive higher credit growth beyond just the liquidity easing and the rate cuts. And that's something I think is worth tracking. And to me, beyond geopolitics, beyond US tariffs, that will be the key to drive a surprise or not drive a surprise. But clearly, there needs a surprise on growth for markets to break out from where we are now.
Gautam, the overarching views that we've had from the buy side, who must be guys that you guys service as well, your peer set might be servicing. But when we talk to them about where is it that they would want to put incremental capital to work for a better part of 2026, and the views seem to be centered around financials, the higher end of consumption, discretionary per se, but even that within that premiumization in a meaningful way, and in some sense, energy transition or some form of energy. Is that a good space that to you guys as well? Do you second that? And is there some additions that you would want to make to that list?
No, these three are themes which our analysts bottom up are also pushing. Exactly the same. Financials selectively in consumption are more higher and more driven by premiumization, including in automobiles, and energy basket as a whole. And energy for us is not just transition, but including the traditional thermal space. Where we are seeing for this entire supply chain, the profit pool will be much bigger. Growth rates will be much higher in the next 3 to 5 years than we have seen the last 5 to 8 years. So these three thematics remain very common discussion point with investors and for us also. Now, depending on the investors, there is debate around IT services. The tactical investors are trying to position for a short-term positive momentum based on commentary, based on currency moves, etc. The longer-term investors are still holding on rather than jumping in. So there is debate around IT services. The other sector where we are quite bullish is the entire quick commerce. That remains an interesting space where we continue to see, including from our analysts, the TAM estimates expanding. So it's not just the stocks have done well, but it's also backed by TAM analysts expanding, TAM numbers or estimates expanding.
Okay, and at least final question from my end to you, Sunil. The other opinion that seems to be coming is that if 2025 was marked by being completely bottom up as a market, for India at least, and then you look at other emerging markets as well, could it be quite the reverse in 2026 in that there could be a top-down approach? Sure, bottom-up ideas will work, but could there be a top-down approach in that as a market, maybe the index could rally as a much safer proposition as opposed to trying to be very picky and ignoring the large caps and the index?
Unlikely in our view, right? So, I mean, we don't expect, so the condition that you're talking about is essentially one where there is a big rally in the index or a big correction in the index. A lot of stocks go up together or a lot of stocks go down together, which means that there's a big common theme, top-down theme that's been playing, and you need to get that theme right. We're not expecting that heading into next year. So it would still remain, very bottom up. You need to look at, sectors where there is the turn that's happening on the earnings, momentum, where upgrades are happening, where positive surprises, that Gautam mentioned, are expected, and so on. No, we don't expect that, even not just for India, but even at a global level. Our expectations are, even for the global indices, our upside on equities in dollar terms is not more than 10-12%.
Okay, so interesting conversations coming in there. But thank you, Sunil. Thank you, Gautam, so much for joining us on the show. It's always a pleasure to speak to both of you on India Market Open.